It's March and investors are talking about tax harvesting. So, what does it mean?
So tax harvesting basically in the month of March, it's a good practice to do, which means that if you have invested in mutual funds, stocks, or any of the equity-based instruments, and you're sitting on a profit of say a few lakhs on one particular account, and you have multiple accounts under your family member's name, so there is a LTCG exemption of 1.25 lakh rupees per annum. So you can do that part of it before 31st March. So supposedly you have 10 lakh rupees invested in the mutual funds, that's become 12 lakh. So you're sitting on a 2 lakh rupee gain. So you can actually withdraw up to 1.25 lakh rupees of gain, which means approximately 11 and a half odd lakh rupees. You can withdraw and reinvest the same the next day or the next week, maybe in the same scheme or in the some better performing scheme. So this also helps you to have a look on your overall portfolio mix. So it's a good habit. Similarly, from September 2024 till March 2026, many of the mutual funds schemes or many of the direct stock investments have undergone a loss despite the tenure being more than a year. So that is called something called as a long-term capital loss. So supposedly you invested 10 lakh rupees, that has become 8 lakh rupees. So you're sitting on a minus 2 lakh rupees of loss. Given that you don't see any recovery happening soon in those particular stocks or mutual funds, you can actually book your losses and compensate this loss with future gains, maybe in the next financial year also, because you can carry forward long-term capital losses for 6 to 8 years, and for sure in the coming years you will make profit, so you can compensate for, towards that. So that's some of the tax harvesting ways. And similarly, if you have big capital gains in your mutual funds, so then you can buy a property also against it, and so on and so forth. To know more, you can put it in the comment section and we'll be happy to discuss on a one-to-one basis.